Welcome to this explainer. Today we're doing something a little different. We're going to take a deep look right inside the engine room of the global financial system. We're diving into a brilliantly fascinating and honestly sometimes terrifying book called The Money Formula by mathematicians Paul Wilmott and David Orrell. This text sets up an incredible tension that pretty much defines modern economics. The battle between pristine, elegant mathematical models on one side and the messy, chaotic, deeply emotional reality of human behavior on the other. Have you ever wondered why financial markets seem to operate with flawless mathematical precision one day, only to completely fall apart the next? Well, we're going to unpack exactly how that happens and explore why the very models designed to protect us from risk might actually be the things creating it. To really grasp the stakes of what we're talking about here, consider this number, $1.2 quadrillion. Yeah, quadrillion. According to estimates from 2010, this was the notional value of all the financial derivatives in existence worldwide. This incomprehensibly massive figure represents the shadow economy that drives global finance. It's not just some large abstract number, it is literally larger than the entire global physical economy itself. And it forms this invisible web of risk that your pension, your 401k, and your life savings are deeply entangled in. Okay, let's really dive into this, because a number like 1.2 quadrillion kind of loses all meaning, right? To put it into perspective, Wilmott and Orrell calculate that it equates to about 17 times the market capitalization of all the world's stock markets combined, or roughly 150 times the value of the entire above-ground gold supply. When you break that down individually, it represents about $170,000 for every single living human on the planet. That means $170,000 in shadow money is riding on your shoulders right now. This is the terrifying scale of the quantitative finance industry, an industry built entirely on mathematical equations that dictate how money is created, traded, and supposedly kept safe. All right, part one, alchemists and gamblers, early financial models. To figure out how we ended up with a financial system of this magnitude, we have to rewind a bit to the early 1700s. We're going to look at two wildly different historical figures. Think of them as the ultimate odd couple of finance. On one side, we have John Law. He was a Scottish gambler, a fugitive, and a mathematical prodigy who ended up in France and essentially invented modern paper money. He created a state bank backed not by gold, but by state authority, and tied it to a massive trading monopoly called the Mississippi Company. He used paper money to artificially pump up the stock, creating this wild economic boom, and actually minted the very first millionaires before the entire system violently collapsed. On the exact opposite side, we have Isaac Newton. Right around the same time Law was printing money out of thin air, Newton, the solitary scientific genius, was serving as the warden of the mint in England. He took the completely opposite approach, rigidly tying the English pound to the physical gold standard. It was his attempt to bring absolute, predictable, physical order to the world of currency. These two guys perfectly represent the dual nature of finance, the intense desire to use math to wildly invent and gamble versus the desire to use math to strictly control and predict. Building on Newton's desire for predictable order, we meet Adam Smith, who is widely considered the father of modern economics. But here's the funny thing about Smith. The man was very, very different from the perfectly rational systems he imagined. He was famous for some truly bizarre behavior, like absent-mindedly walking into a tanning pit needing to be rescued, or wandering 15 miles outside of town wearing nothing but his nightgown. Plus, he lived a life of deep dependence on his mother and wealthy benefactors. Yet, out of this deeply eccentric, highly dependent life, he birthed a theory of an economy driven by fiercely independent, perfectly rational actors. You've probably heard of Smith's most famous concept, the invisible hand. He essentially took Isaac Newton's concept of gravity and applied it directly to society. Just like gravity forces the planets into a stable orbit, Smith theorized that the unseen hand of the free market forces prices and supply into a natural, stable equilibrium. It was a beautiful, deeply comforting thought, honestly. It transformed the messy, unpredictable marketplace into this highly rational, stable Newtonian machine that always returns to a state of perfect balance. Which brings us to Section 2, the rational illusion, mathematical economics. Let's look at how 19th and 20th century economists attempted to turn Smith's comforting philosophy into an exact, measurable math. So, to build functional mathematical models of the economy, economists ran into a massive, glaring problem. Real humans are incredibly unpredictable. So, what did they do? They invented a fake one. They created Homo Economicus, rational economic man. This theoretical being acts purely out of self-interest, never changes their mind without a strictly logical reason, and calculates the exact utility of every single decision. Wilmott and Orrell point out that this was done simply to make the math work. It is infinitely easier to calculate the actions of perfectly rational, selfish robots. Actually, scratch that. It's pretty much the only way to make their models function than it is to model the behavior of actual human beings who change their minds, follow silly trends, and make bizarre life choices. Moving right along to Section 3, Going Random, Probability in Markets. This foundational assumption of pure rationality led to a really big idea, that price movements are just a predictable, calculated random walk. Take a look at this theoretical 100-step random walk charted out. See that smooth, gray shading in the background? It spreads out over time like a perfectly predictable plume of smoke. Quantitative analysts, or quants as they're called, used probability theory and the normal distribution, which you probably know as the bell curve, to model market fluctuations. In this perfectly rational framework, risk is contained. Extreme events, depicted by those outer edges of the smoke plume, are mathematically calculated to be incredibly rare. It looks safe, it looks symmetrical, and most importantly, it looks entirely manageable. And this feeds directly into the dominant theory of modern finance, the efficient market hypothesis, developed by Eugene Fama back in 1970. The EMH argues that markets consist of a massive swarm of rational profit maximizers. Because everyone has access to the exact same information and acts completely rationally, the market instantly prices every single asset at its exact intrinsic value. Therefore, it's impossible to consistently beat the market. Now, the authors critique this deeply. They argue that the EMH was really just an intellectual excuse, a handy way to take an inherently unpredictable, emotionally driven, chaotic market and force it to look like a perfectly logical, highly efficient machine. It basically explained away why economists couldn't actually predict the future. All right, Section 4, the reality of risk, shattering the illusion. What actually happens when we take these elegant, symmetrical formulas and forcefully apply them to the real world? Wow, okay, just look at the stark contrast here. We're looking at actual data charting 100-day periods of the Dow Jones Industrial Index. Compare this wild chaos to that smooth smoke plume we saw a minute ago. This real data completely shatters the bell curve. You see these massive, wild, asymmetrical swings shooting completely out of bounds. The histogram data proves it does not form a neat bell shape at all. According to the standard mathematical models, some of the historic swings we've actually seen in the Dow shouldn't happen even once in the entire lifespan of the universe. And yet they happen right here on Earth fairly regularly. So what's the deal? Well, Wilmott and Orrell report that real markets simply do not follow the normal distribution of the bell curve. Instead, they follow what's called a power law distribution. While a normal distribution is symmetric and makes extreme events almost mathematically impossible, a power law distribution is fundamentally asymmetric. In a power law system, massive, extreme events, think earthquakes or in this case devastating financial crashes, are not anomalies at all. They are highly likely features of the system. By using the wrong mathematical distribution to measure risk, standard quant models are severely underestimating the true, literal danger of the markets. So, why do the markets behave so wildly? Because they aren't populated by Homo Economicus. They are populated by us. Real markets are driven by what we can call the human glutch, our own behavioral biases. We suffer from status quo bias, right? Holding on to losing stocks just because we happen to own them. We suffer from loss aversion, fearing losses far, far more than we value equivalent gains. We are driven by the power of suggestion and herd mentality, rushing into crazy bubbles and panicking during crashes. These undeniable psychological realities completely tear down the illusion of control that the mathematical models rely on. The invisible hand isn't a rational calculator, it's a deeply emotional crowd. This brings us to a really stark realization, beautifully summarized by Claude Bébéar, the founder of the insurer AXI. He noted, quite simply, finance is not logic. The mathematical models powering that $1.2 quadrillion derivative market are intrinsically incapable of measuring human passion, collective fears, sudden enthusiasm, and blind panic. You just cannot slap a math formula on the madness of a crowd. So, the crucial point is this. If the historical data proves that these models are dangerously flawed, and if behavioral science proves that humans aren't perfectly rational, why on earth does the quantitative finance industry cling to these broken equations? Wilmott and Orrell suggest the answer is as psychological as it is financial. They keep them because without them, the illusion of control vanishes entirely. The industry chooses the comforting elegance of a clean mathematical equation over the terrifying, messy reality of human unpredictability. Because admitting the models don't work means admitting that we aren't truly in control of the giant machine we've built. Which leaves us with one final, lingering thought. Remember Isaac Newton? Well, after losing an absolute fortune in a market crash, he famously lamented that he could calculate the movement of the stars, but not the madness of men. If our global financial system is ultimately driven by irrational human desire rather than rational, predictable physics, can we ever truly calculate and contain the risks we are taking? It's a question that challenges the very foundation of modern finance, and one we all really need to be asking. Thank you so much for joining me on this explainer. Keep questioning the models, and I'll see you next time.